It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. We have a lot to cover today, so I'm just going to jump right into it. And a lot of it has to do with recent economic news that is, I think most people are going to find very valuable, and so that's my goal here, is to help you understand some of the things that are going on that maybe a lot of folks I run into hear about but don't necessarily really fully understand. So we're going to talk about, obviously, inflation a little bit. We've been talking about that a lot. Impact on investments and what to do. We're going to talk about the inverted bond curve, the yield curve, I should say. Something most people I talk to are not very familiar with, okay? So we're going to just jump into it, like I said, and how it impacts us. First thing, and the inflation thing, again, recently the numbers, probably one of the most common questions I get. I've covered this in some of the previous shows, and as I always like to tell people, look, if you missed any of the previous shows, go to yourpersonalbank.com. You can listen to any of the previously recorded shows anytime you want, or if you miss a portion of this show, you can always go there and listen to it anytime you want. There's different topics on each of the shows, so you can listen to anything you want. There's several years now of shows. There's tons of content in terms of the economic news, your personal bank, how it works, how it can impact, improve your financial situation, of course, allow you to gain control of your money, reduce your taxes, get more liquidity, and get positive arbitrage, which is becoming more and more important as inflation continues to rise. And that's what first thing I want to address is one of the number one questions I'm getting almost from, nearly everyone that I talk to is, how long do you think inflation is going to last? And, of course, nobody has a crystal ball. Nobody can say for sure. But what we can do is look at indicators. And one of the two of them, the most, how should I say, accurate indicators most of us have heard of or familiar with this Consumer Price Index, or known as the CPI, which in February came in at 7.9%, the highest in 40 years. And then there's the Producer Price Index. Again, that's what the producers pay, or PPI is what it's known as. That's the rate of what producers are paying to make stuff. And as economists, sorry about that, got tongue-tied there for a sec. Economists often say that the Producer Price Index is the better indicator, particularly of where inflation is going to be in the future, because typically, on average, what a producer is paying for something to make it, gets to the consumer about 6 months later. So those numbers were 10% in February of 2022. Incredibly high numbers. So I think certainly some of the highest numbers ever recorded. So what that's telling us, what the Producer Price Index is telling us, is that inflation is probably going to be around 10% about 6 months from now, so this fall. Now, that's what we need to understand. And the other part to understand about the CPI and the PPI is, if you've noticed or been paying attention, they're on the increase. They're on the rise. Pretty much each and every month they've been increasing. So in other words, they're climbing, they're going up and up and up. And just like if you were a hiker hiking a mountain, right, we haven't crested that mountain yet. Or, well, certainly the Producer Price Index is telling us we haven't crested that mountain yet. And until we start seeing these numbers start to decline, obviously we haven't crested the mountain and gotten over to the other side. So the Producer Price Index is telling us that things are going to be on an increasing line, so to speak. Inflation, things are going to cost more, certainly for the next 6 months or so. And then, it could easily be longer. We've got to start seeing those numbers start to decline, reduce, instead of continuing to go up. And as I stated in one of the shows last week, and again, if you missed it, go to yourpersonalbank.com to listen to any of this or any of the previously recorded shows. I was discussing how, energy, did the whole show pretty much on energy, the impact energy has on inflation. It's one of the biggest impacts, on inflation, because, It impacts the cost of everything because cost of goods that we purchase are transport. Almost everything is transported, and so it impacts the cost of goods, from everything from food to clothing to anything we buy, pretty much, right? Whether you go to the store or whether you have it shipped to you, it still gets transported, right? So energy has the biggest impact on inflation, and as I stated, our current energy policy with the current administration is to reduce or discourage energy production in this country, which is sad because when we want to be, we're the number one energy producer in the world. That's what's so ironic. When you pull back on production of energy for the largest producer in the world, that's going to reduce supply. Plus, there's a war going on, which is also impacting supplies, which forcing the prices up. And at a time when we're seeing all-time high gas prices, that's why we're seeing inflation. A recent article just came out, a study by the San Francisco Federal Reserve. Certainly no conservative group, right? They came out just recently stating that approximately half of the inflation we're dealing with right now is from excess government spending. It's what we've been talking about for quite some time, and most people know. But at least they're, admitting it, right? So all these things that are going on, the reduction of energy, the discouragement of generating more supply of energy that impacts just about everything on inflation, the excess government spending, these are the things that are just dry. It's like throwing gas on a fire, right? What's so frustrating is our current administration, the elected and non-elected officials keep saying that, they're addressing it, they're dealing with it, but then their actions are completely the opposite of what they're saying. In fact, it seems like that there's a group that's in Washington. They're sitting around, they're saying, well, what's the worst thing we can do to make this worse for the average American, the middle class, the poor, most of us? And then that's exactly what they do. Some of the latest things they're proposing now is like releasing 1 million barrels a day of oil from the strategic reserve. Now, that's supposed to be for an emergency, like if we were attacked or, somebody invaded the U.S. And it's supposed to be about a 30-day supply for the military to operate on, okay? Well, if you're going to drain 1 million barrels a day for the next 6 months or so, as they're proposing, that's just going to further deplete our emergency reserves in case we have a true emergency. What if something happens and somebody, we get into a war of some sort, right? Just make it further weak. Again, and it's going to do so little. 1 million barrels a day is nothing. I think we do something like, and don't quote me on this, but I think we use something like 8. Last I looked, I have to look this up again, but I believe it's 8 million barrels a day the U.S. uses. I don't know, something like that. It'll have a very minor impact in terms of prices, reducing the prices or increasing supply. The real solution is simple. We have the natural gas. We have the oil. We can extract it. We can extract it cost effectively and cleanly. And then we would have the energy we need to drive our economy and live the life that we want to live as Americans. And then it would also here's what's so ironic about it. By having a stronger economy, it would actually enable the ability to generate the technology to get green energy more efficient, more commercially viable. But no, it actually is hurting that too. Okay, but again, that's not the true goal, in my opinion, of this current administration. It's really about power and control and money. I always say follow the money or power. They would just want more and more people relying on government so that they can gain more control and votes, right? It's really about, again, sitting around what's going to hurt the people more and create chaos, right? But that's a personal opinion, but I think it's very well documented. How's that? So the thing is, I'm going to encourage you to stay tuned into the next segment because I'm going to start talking about the inverted yield curve And again, this is something, again, most people that I talk to have little or no understanding of this. But what's key about the inverted yield curve, and we're going to discuss further, is it's actually been one of the best predictors of recessions, period. In fact, since 1955, it's predicted every single recession except one. So it's a very significant indicator of the markets and, of our economy and the how should I say, the recessions, right? So we'll get into that more in the next segment. But the thing is, to address the question I started with, and I guess to finish it, I'm answering the question, but I'm kind of wandering a bit, and I apologize. It's how long will this inflation last? Well, again, with energy being the biggest impactor on inflation, and the lack of supply, or the reduction of supply, I should say, the discouragement to not allowing any oil leases on federal lands, for example, reducing the ability for oil energy companies to generate the energy we need for our economy to go, and reduce inflation and reduce gas prices and all that, heating oil, everything else that we use, until they change their tune, like I said a week ago, or OPEC decides to ramp up production big time, which they're showing no indication of. They're making record profits right now. Why should they, right? Unless we see a major change like that, we're going to be dealing with this for the next 3 years, right? I mean, the only other possibilities in the midterm elections, we get the House and Senate a veto-proof majority of Republicans, and then they basically vote legislation to issue oil leases, right? And Biden can't override it because it's a veto-proof majority. Short of those kinds of major significant changes, the reality is, folks, buckle your seatbelts. And I was telling this to a client literally a day or so ago, and she goes, "That's not fun." I said, "I didn't say it was fun. I'm being honest with you. Buckle your seatbelts. We're going for a ride for the next 3-4 years, because even if we get somebody in office or administration, say 3 years from now, that dramatically changes direction, it's going to take 6 months to a year to get things, back online and going again, right? So buckle your seatbelt for the next 3-4 years. If you want to learn how to offset inflation, create positive arbitrage, which again, as inflation increases, you got to make your money work more for you. This is becoming more and more important. Your personal bank can do that. Contact me at yourpersonalbank.com or toll free 866-268-4422. Again, that's yourpersonalbank.com or 866-268-4422. And stay tuned in the next segment, because we're going to discuss the inverted yield curve. I think you'll find it interesting.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And like I said earlier, we're covering a lot of ground today. We're discussing different things like the recent economic news in terms of the consumer price index, the producer price index, how long we think inflation is going to last. If you missed all that, go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows anytime you want. But I wanted to discuss the inverted bond curve, because this is one of the most recent big news events from an economic standpoint, that is. And why this is important, and I'm going to explain it further. When the bond curve has inverted, which means the short-term rates are higher than the long-term rates, every single time since 1955, except once, the inversion of the bond curve has predicted future recessions. It's considered one of the best indicators of recession out there. And on average, according to a study by the San Francisco, the Federal Reserve Bank of San Francisco in 2018, they pointed out that the recession followed between 6 and 24 months after the bond curve, after it inverted. It only offered one false signal in that time frame. So from 1955 to the present. So it's hugely significant. People are aware of it. And even if you go back further, if you go back since 1900, so we're looking at about 120 years of history, There's 28 times in 120 years. So it doesn't happen very often, but 28 times the yield curve is inverted, and 22 of those times a recession followed. Okay? So it's a very, very significant and very often accurate predictor of recessions. Now, and that just happened very recently. So what is the yield curve? Okay, so bottom line is the Treasury, there's the bond market. So a lot of people are familiar with the stock market, of course, but far fewer are familiar with the bond market. Now, the bond market is far larger. It's over, like this article is talking about, it's over $23 trillion in assets, the Treasury market. It's huge. In New York and Wall Street, so a lot of times it's referred to as the smart money. It's often where the institutional investors invest, okay? The big boys, right? Big boys and girls. So this is what the smart money is doing, and they're predicting, basically, because of this bond yield inversion, a recession coming in the next 6 to 24 months. And what it is you have different maturities of Treasury bills and bonds and such. And you've got all different time frames from 3 months off to 30 years and everything in between. And the thing is, the 2 year, typically, so again, to try to keep this simple, the shorter term usually gives you you get a lower rate or lower yield. You make less, you get a lower interest rate. A longer term, because you're investing your money for a longer term, you usually get paid a higher interest rate when you invest, right? That's typical, and that's the way it is most of the time. When that inverts, like it did very recently, the 2-year and 10-year inverted, in fact. So in other words, the 2-year bond notes, Treasury bills and notes, pay you more interest at the moment than the 10-year. So in other words, bond buyers, bond purchasers, and again, these are most often, very large institutional investors. What they're saying is the risk is higher in the short term than the long term. They want a higher interest rate, higher yield is the term that's used. They want more money to take on the risk. So the 2-year and the 10-year are inverted or have inverted recently. And so this is, again, another one of those. It's like I told my wife, I said, well, another shoe just dropped showing that it's extremely likely that we're heading into recession. And like I said, this report was from the San Francisco Federal Reserve Bank. So it's not like they're filled with a bunch of conservatives if you're thinking about the political part. They also, interestingly, the San Francisco Reserve Bank just recently came out with studies stating that the current inflation we're dealing with right now, about half of that, about 50%, is due to excess government spending. So in other words, all this COVID relief stuff and all this money that the government has helicoptered into the economy over the last couple of years is causing prices to increase. Energy prices are also responsible, for the most part, for most of the other half, basically. So it's a combination of the government's spending too much money and energy prices are too high, and both of those can be directly attributed to our federal government. So I had somebody, and I've said this before, I had somebody who's a client of mine who, we don't agree on things politically, but we still respect each other. And he was saying something about, I said, the perfect example, the first day, the Keystone Pipeline, that Biden shut that down. He goes, well, that didn't make a difference in gas prices or whatever. I said, no, it whether it did or didn't is not the point. The point is it sent a signal. It sent a signal that the government was now hostile or discourage energy production. And, of course, they haven't allowed any leases on government lands to drill oil or natural gas, okay? And, again, when we want to be, this country is the number one producer of energy in the world. We have something like, they tell us, 100 to 200 years of known reserves in oil and natural gas based on the current technology. So, obviously, there's more. I mean, that would give us 100 years to figure out green energy or some other alternative, wouldn't it? In a, a common sense approach to moving to more green energy sources. But common sense hasn't led to any of this situation. And like I said in the first segment, it just, the farther we go down this path, and the refusal of the administration to do the things that would actually genuinely make a difference and genuinely help, instead of releasing them, they're talking about releasing 1 million barrels of oil a day for the next 6 months from the strategic reserve, which will just make us weaker. That's our emergency reserve in case we have to go to war. And if we have less reserves, we have less capacity, less capability of defending ourselves. Again, it feels like there's a group of people sitting around a table and saying, hey, what's the next thing we can do that hurts America? Because if they were incompetent, or they were just plain stupid or out of touch or any of those things, I've said this previously too, they would accidentally do something right, or they would be beneficial just purely by accident because they were out of touch or just that foolish, right? No, they're not foolish or stupid or any of that. That's very, very well thought out. They're doing the things that hurt our economy, hurt average Americans. And unfortunately, unless something significant changes, we're going to be dealing with this administration for the next 3 years. And again, we can point to the administration being the number one cause for the high energy prices, okay, and the spending, right? And that's what we're going to talk about in the next segment as we come up, because Biden administration has come up with their budget, or whatever, the next budget proposal, which again, of course, would be the highest tax increase in history and spending increase in history, which is exactly what you need when you have inflation, right? More government spending. Even the San Francisco Federal Reserve is saying that's causing a high inflation. Stay tuned in the next segment. We'll discuss that further and the solutions, what you can do. One of them is contact me at toll-free 866-268-4422 or yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And, of course, today we've been discussing some recent economic news, some big events that have occurred that, well, all indicators point towards recession. I mean, just about everyone knows that we're dealing with a high inflation environment. All you have to do is go fill up your gas tank or go to the grocery store, and you can figure that out really quick. Prices have gone up significantly, and in most parts of the country, gas prices, for example, have nearly doubled from a year ago. I mean, the average price of gas, I just was reading, was in the mid-twos, like $2.60 a gallon about a year ago, and now are like $4.60 a gallon. I saw driving a day or so ago here in Arizona, Phoenix, which is normally tends to be a lower. Our gas prices tend to be on the lower end. We're not like Texas, but we're on the lower end. Almost $5 a gallon gas. I've never seen that. I've lived here over 20 years. We've never seen it. It's all-time high, and that's what we're seeing across the country. And, of course, the reasons behind it, as I talked about in the previous segments, are obvious, from the current administration discouraging energy production, the war going on with Russia and Ukraine, obviously, is an impact. And the government spending, according, like I said, recent study just put out by the San Francisco Reserve Bank of San Francisco. I'm sorry, the Federal Reserve Bank. Again, they're saying about half of the current inflation is caused by the excess government spending. And if you're thinking from a political standpoint, I don't think the Federal Reserve Bank of San Francisco leans very conservative. You know what I mean? So, and I think that's actually pretty accurate. And then the yield curve. The inversion of the yield curve has predicted in recessions every single time since 1955 except once. So it's typically a very, very accurate predictor of recession. Now, I was talking with a client just a day or two ago, and again, the question is, how long is this going to last? Well, until energy prices drop, our administration has to change their tune, or OPEC has to step up and produce a lot more, and don't see that happening anytime soon. They're making record profits, right? If we saw this, we're seeing this. I think we're leading clearly It's leading towards a set 1970s type of recession that we saw. And those of you old enough to remember those days, or you read your, do a little bit of history lesson. There were two impacts, OPEC, basically in the early 70s and at the late 70s, really impacted the economy by raising prices significantly. And again, energy prices went up, all-time highs in both cases, and it caused a tremendous inflation in both cases. And in both times, it affected the country for several years, okay? So, as I said to this client, buckle your seatbelt because it looks like we're in for a ride for the next three to 4 years. Again, unless something significantly changes that we don't see right now. She was, we're not hearing that from our, I love this. So she was showing me a letter. So she was invested in a brokerage account, and she just had recently gotten a letter, and I won't see which company because, frankly, I don't want to embarrass them. But it was funny. We read the letter, and she pointed out, it said, well, things aren't, yes, inflation is getting high, but it's not going to affect the market. It's not going to be too bad. But then later in the letter said, yeah, it's going to be bad for a while. So basically they're saying, yes, it's going to be bad. No, it's not. And you're getting mixed messages, mixed signals. And we heard that, of course, from our political and our bureaucratic leaders on the Federal Reserve. Initially they were saying inflation was transitory. We remember that. And then they started saying, well, it's going to be over by the end of the year, and they meant 2021 at the time. Of course, when it clearly wasn't, then they say, well, probably going to 2022 or so. Well, now they're saying it's probably going to go through 2023. The reality is, folks, they don't know. And they don't. And the other part is they don't really want to. She says, why are they saying all these things? Well, the other part is they don't want to create panic among the people, right? Now, some people ask me, why are you sharing some of these things? Because, unfortunately, I wish I had better news. I really do. But my attitude is simple. I said this to this potential client. I said, I don't know about you, but I think I'm with a lot of people. I'm just sick and tired of being treated like a little kid. I think through all the COVID shutdowns and all that stuff, my attitude was, look, I'm a big boy. I can assess the risk for myself and my family and decide what makes sense. I don't need you or anyone else telling me what to do. Give me the facts. Let me make a decision. So I would rather know that the inflation is probably going to be around for 3 or 4 years, and we got to buckle our seatbelts unless something major changes, than be told something else because they don't think I can handle it. If I've got the facts and I've got the information and the numbers, I can make better decisions, right? And that's how I like to treat people, like an adult. Stay tuned in the next segment. We're going to finish up with some fewer thoughts and some solutions I think you're going to like, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And first of all, I just want to say I really appreciate the folks that have been listening and responding and reaching out to me. You can email me at Ference at yourpersonalbank.com. It's F-E-R-E-N-C, as in cat, at yourpersonalbank.com. Or you can go to our website, it's yourpersonalbank.com. Or you can contact me. I mean, that's the other thing. A lot of people say, wow, when they call or contact me, they go, wow, it's really you. I said, yeah, you're really going to get me. It's toll-free 866-268-4422. But what I want to say is I do really appreciate the folks reaching out to me. And, you've been listening to the show most of the time. When somebody contacts me, they've been listening for a number of months, if not years. And overwhelmingly really like what I have to say. And I think what it really boils down to is I'm doing my level best to share the unvarnished truth, cutting through the noise. Yes, I have political opinions about things, and I share those openly so folks know where I stand. But I guess what I'm trying to say is I try to be really transparent about it and just use some common sense. Because I think common sense is normally uncommon anyway, normally. But gosh, it just seems like it's almost all but disappeared, right? In the last couple of years especially. And I'm sick and tired. I said this in the last segment. I'm really sick and tired of being treated like a kid or being lied to or misled or holding things back because they got political agendas whatever that may be, right? I don't know about you, but I'm just flat out sick and tired of it. I'm sick and tired of being sick and tired. I want to know what's going on. Give me the facts. Let me decide. Let me decide what's best for me, my family, or whatever, and make, good economic decisions or whatever for myself and my family, right? So when I get asked, why are you sharing some of this information about like the economy and stating that, well, unless something major changes on energy policy or OPEC starts drilling a lot to create more supply, we're going to be dealing with higher than normal inflation rates for the next 3-4 years probably until the next administration changes the tune, right? Because it's the facts, folks. You can't have high oil prices and high gas prices and high natural gas and have low inflation. The two don't go together. 2 plus 2 still equals 4, no matter how much you try to complain about it or try to change it. And I know there's some out there that are trying to change that, but whatever. Math is math. It doesn't change, okay? So what are some things that we can do? And what can we expect? So if we are going to have to buckle our seatbelts and ride this roller coaster, this economic roller coaster of high inflation, high prices, probably a recession. Some are even talking about stagflation, which would be even worse. That's where you have high inflation with a slow economy. So everything's expensive and there's not much economic activity, shortage of jobs and all that kind of stuff. That's the worst of all worlds. We saw that in the 70s. We could easily slide into that kind of thing again. I don't know. We'll see. But I think any intelligent person needs to be prepared for that. And so when you have this kind of economic change of direction, which is dramatic compared to even a year ago, we've gone through the last decade plus since 08-09 of extremely low interest rate environment, super cheap money, easy to borrow, particularly for businesses, individuals, whatever. That fueled a tremendous stock market boom and real estate boom, okay? Those low interest rates are great for those asset classes, for the most part, most stocks and real estate. When we have such a massive shift, and I've shared this, so for example, as many of you know, for the last number of years, for quite some time, somebody with really good credit could get a 30-year fixed mortgage in the 3% range. I've even seen some in the high 2s. Okay, and this is going to be important to know as I explain the personal bank here in a minute and the borrowing rates and how you can get positive arbitrage. So if you had really good credit, you could get a 30-year fixed mortgage around 3%, okay? And you could for quite some time. Not today, but up until recently. Now, the Federal Reserve does what they say they're going to do, and to their credit, one thing they have done is they've been very transparent in telegraphing what they're going to do. So that part I'll give them credit. They're way late to the game. They should have done this far sooner because now they've got a mess on their hands, frankly. They got a fire rate. It's like having a forest fire raging out of control. The government's been throwing more gas on the fire by helicoptering money into the system and then causing energy prices to go up by discouraging energy production, okay? That just does nothing to make the wildfire rage more. So now the Federal Reserve's starting to take the very first steps to do something about it. They were also contributing to the problem by buying bonds and mortgage-backed securities for the last, year and a half or so, which further enhanced asset prices, both for the stock market and real estate markets. They finally stopped a month or so ago purchasing this stuff, and now they're switching to raising interest rates. And then in May, they're talking about they're going to put out the plan. They have $9 trillion on their balance sheet, which means they bought all these assets, stocks and mortgage-backed securities and all this stuff, bonds, all these things. They're going to start selling some of that stuff. They're talking about selling about a third of that. That's like $3 trillion, folks. We don't know what kind of time frame yet. We're going to find that out, I guess, in May. But when you have, that's like the Wall Street always says, don't fight the Fed. That's the biggest buyer. That's the biggest buyer on the market. Okay, the Federal Reserve. And when you have the 800-pound gorilla tip their scales, okay, if they're a net buyer, they're buying everything in sight for the last year or two, and then they stop buying and then turn around and start being a net seller. They're selling everything in sight. What's that going to do? the prices. Okay? These are the things you need to understand going forward, right? So, again, as I was starting to say, if the Federal Reserve raises interest rates by 3% by the end of 2023, as they're stating they're going to do, they've already stated this, that means a 3% 30-year fixed mortgage for somebody with gold credit was 3%. By into next year, it'll be 6%. Folks, that's doubling the borrowing cost of money. See, a lot of people get messed up, and they think, well, moving from 3 to 6%, that's a move, but that's not that big a deal. It's only 3%. No, it's doubling the cost of borrowing money. That will have a massive, and I mean a massive, impact on business and business profits and the bottom line, many stocks, okay, real estate and everything else out there. Obviously, different companies and in the stock market will be affected differently. Obviously, different markets in the real estate world will be affected differently. If you're in a place where it's net move-ins, like here in Phoenix, we still have more people moving in than leaving, so that'll be offset to some degree, but most experts, and my personal opinion is, we're going to see a correction even here in Phoenix. We'll see, but everything's pointing to that. So my point is, with high inflation, again, buckle your seatbelts. We're going to be in for a ride for the next probably 3 or 4 years. You need your money to go further. Because, again, with the consumer price index going up by 7.9% by the end of February. What does that mean? Is basically the cost of everything on average has gone up about 8%. In other words, if you went to the grocery store and you spent $100 on food last year, this year you go to the store, buy the same identical items, you're going to pay $108 for it. Now apply that to everything that you purchase. And you can start to see where those who don't have a lot of cash reserves or a lot of wiggle room are already starting to suffer. And this will cascade throughout every aspect of our economy and through basically there's going to be no escape from anyone. It's like a tsunami. We're stuck. We're going to have to ride this out. Buckle your seat. That's what I mean. Buckle your seat belts. We're going to ride this ride whether you like it or not. And you're going to be affected by this whether you like it or not. Because you know what? We all eat, don't we? So at the very least, you're going to be affected. And most of us put gas in our gas tanks, right? Or other things like that. So we're going to be affected. What that means, folks, is really quite simple. It means what you've been doing probably the last decade probably is not going to work, at least for the next 3 or 4 years. And human beings are creatures of habit. And sometimes that can be a asset, and sometimes that can be one of our greatest liabilities. It's called the comfort zone. In other words, somebody, that's the thing I run into. Is like, well, I've been doing it this way for so long, it's been working. I say, I understand. And you're right. You were in the right economic environment to do that, and it's worked great for the last 10 or 12 years, and now you're comfortable, you're familiar with it, and it's worked. But the game has changed. In other words, you've been playing baseball. And you're a good baseball player. You've become a good baseball player, and you're doing really well. Guess what? We're now playing football. And you've got to learn to change with it. If you don't make the change, if you don't adapt, just like the dinosaurs, you're going to die, right? You're going to be affected. That's really what I'm trying to help people understand, is it's going to impact you. So getting your money to work for you further is more important in a higher inflation environment. It's more important. It's becoming more important than ever. And that's why the positive arbitrage, and I know I keep coming back to this, but if there was ever a time to create positive arbitrage, now's the time, folks, because interest rates are only going up. And whatever rate of return, here's a great example. Increasing the inflation rate of 8% means you have to make 8% return on your money just to break even. You have to increase, if you're working, you have to increase your income by 8% just to break even. You're not getting ahead. You're just breaking even. You're just treading water, folks. So let's just use an example. Let's say whatever you were invested in was getting an 8% rate of return. You were previously with low inflation rates and stuff, you were making money. You were growing. You were moving ahead. Today, you're just treading water. And if you're not getting a raise of income of 8%, or your business income hasn't increased by 8% over last year, or your investments didn't increase by 8%, you're moving backwards, aren't you? So getting the positive arbitrage by putting the funds into a policy to get high cash value dividends, which, by the way, we fully expect to increase because dividends are highly interest rate sensitive. In fact, I've been asked that by a lot of people too. How's a personal bank and the dividends going to go if inflation goes higher? If it gets, a lot of times, what happens if we get into double-digit inflation and all that? Which, again, the producer price index is telling us that it's at 10% in February 2020. That tells us about 6 months from now, our consumer prices should be around 10%. Again, unless something major changes, that's 10% inflation, folks. And that's what the government counts. That isn't everything we spend, but that's how the government counts it. My point is simple. You've got to have the dividends will increase with higher interest rates, and it's historical and they're highly correlated. So actually, I said, if we get a really high interest rate environment, like we saw in the 70s, these things were paying double-digit dividends. It could end up being the best investment you have. You'd be dancing on the street. You'd be glad you did it. But on top of that, in the meantime, it's not just about the dividends, folks. I mean, as good as that is, it's also about the positive arbitrage. By being able to borrow at a lower rate than the dividends you're earning are higher than with the borrowing rate, and you keeping the difference. And like I said, the historical average is 2 to 3%. So in our example before, if you were making 8% return on your money, you're now making 10 or 11. That's a huge difference. If you were making 10% average, you're now making 12, 13. That's 20, 30% increase in returns. That can make the difference, folks, on offsetting or helping offset inflation. If you want more information, contact me at yourpersonalbank.com, toll-free 866-268-4422. And yes, if you call or email me, you will reach me. Again, it's toll-free 866-268-4422 or yourpersonalbank.com. And as always, continue to listen, and thank you for listening to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.